All right, I hope you guys are having a fantastic day today. This will be another stock picking video of mine. We just put one out yesterday and it's doing fantastic. Thank you guys so much. Almost 10,000 views already and over 500 likes. But let's try and make this video do even better than that. I'm a competitive person, so if you don't mind, hit that like button down below. And while you're down there, if you're not subscribed yet, make sure you subscribe. I love seeing all the new faces pop into the YouTube channel. In yesterday's video, I mentioned there's going to be kind of a series of videos coming out because I think there's a unique opportunity in the marketplace right now for companies that are going to benefit from AI moving forward, but their valuations, they're not reflecting that right now. The thing with AI, largely with AI right now, is that we've just rebranded big data. We've just rebranded what's been happening in data centers for years as this catchphrase or buzzword AI. That's all we've done. But the future of AI, and I don't know if many people realize this, I talk about all the time how I'm a contrarian investor, and I think for myself, and I do a lot of research, I think the future of AI is actually at the edge, where you're taking what happens in a data center and you're mobilizing it and you're ruggedizing it and deploying it on the spot, at the job, on the fly, at the edge. And that's what this company today does that I'm going to be talking about. I'm extremely confident in this investment. I'm extremely excited about this investment, but there are a few risks that I want to mention here before we dive into it. First of all, this video can get you started on your road to due diligence on this company, but you must go out and do research and due diligence of your own if you want to be a legitimate investor in this company. This video cannot do the entire company justice or the entire investment thesis justice. I'm going to do my best, but you have to do your own research and due diligence. Second of all, the AI market at the edge has really yet to develop or grow up. And to be truthful with you guys, that's simply because it's actually something that's new. It's not something that's been around for years like what happens in data centers. This is something new that's developing, but that also means the companies that operate in this space are less known. They're actually mostly unknown, and they're usually less established, which increases the risk of an investment. But let's just get into it. The company I'm talking about today is One Stop Systems, ticker symbol OSS. You'll notice the market cap of this company is only $78 million. So this classifies as a penny stock, again, which is very risky. In this video, I'll lay out to you the fundamentals, their financials, the tailwinds that are at the back of this company, and why I believe that I'm getting started investing in a company that will easily 10x over the coming years and probably will much more than 10x if AI really does go where I think it's going to go. If you want to buy this company, because it is such a low market cap stock, they don't have very many shares outstanding. Do not market, buy, or sell this company. You must set limit orders or you'll be hosed over on your buy or sells that you do. So there's my little catch. I'm sure tomorrow this stock will still be up 10% plus from people that just go in and market order the stock for no reason. Please don't let that be you. Do your own research and due diligence, and then use limit orders. Get the price that you want. Get the price that you deserve. Now, prior to today, One Stop Systems stock was actually trading down by quite a bit. We've owned this. When I say we, I'm talking about this YouTube channel and the members in the Discord server, etc. But I have owned this for over a year now. I was buying in the $2 range here at the end of 2024. So we have already seen significant return on this investment. It has already doubled up in, basically half a year. This has come a long ways, but leading up to today, over the past month, One Stop Systems was actually selling down, and it's because of the Department of Government Efficiency. You see, the area where AI on the fly or AI at the edge is really starting to develop is with the Department of Defense, with defense contracts and really military applications. So at least half of One Stop Systems business right now is focused on government contracts. The other half is commercial contracts. But this makes them susceptible to any sort of budget cuts that might come to the Department of Defense. And it was just announced the other day that, The Department of Government Efficiency is going to audit the Department of Defense, and they're going to cut spend at the Department of Defense. Now, one thing that I don't think many people realize, and again, this is just kind of presenting another opportunity. You'll notice that that's a common theme with my stock picks, is the markets aren't realizing something. Stock Talk Weekly put this out. Initially, the market will interpret the Pentagon budget cuts as a cause to sell all defense stocks. And I wouldn't classify One Stop Systems necessarily as a defense stock because it's much more than that. And especially as time goes on and the AI on the fly really develops, it's gonna maintain the 50-50 commercial defense revenue split. But he says underneath the surface there is an impending rotation of $900 billion per year in spend away from legacy defense and toward next gen defense technologies pioneered by smaller companies. And I tweeted underneath it the ticker symbol OSS with the shushing emoji. And I think this is a very, very important point. And he's talking about this, how the Pentagon needs to divest to invest and embrace more nimble procurement, which was just a report that the Defense Innovation Board put out. They talk about it here. And I'll zoom in on this because I know it's small print for you. But they say the Department of Defense's nearly $900 billion annual budget is a massive resource, yet much of it is locked into maintaining outdated systems rather than advancing innovation. Budget documents show that nearly 40% of the Department of Defense budget is allocated to operations and maintenance, much of which sustains legacy systems rather than modernizing critical capabilities. So even if there are budget cuts that are coming to the Department of Defense, much more of the spend, there's a big push underneath the surface for spend on new technologies so our country doesn't fall behind. That's actually just another tailwind at the back of One Stop Systems business when it comes to their government relations and their government contracts that they sign. If I haven't made it clear enough yet, One Stop Systems operates as an AI on the fly, AI at the edge company. They take that remote data center and they mobilize and ruggedize it to deploy at the job, at the edge, on the fly. This industry alone is expected to have a CAGR of 33.3% until 2032. This is one of the fastest growing industries out there right now. In the video yesterday, we talked about the BESS industry, battery energy storage system industry or market, which has a 25 to 30% CAGR. That's a common theme with these investments that I'm making right now. But as always, let me just walk you through some slides on their investor presentation. You'll see at the top that this is 38 slides long, so I'm not going to be going through all 38 slides, but I'll be going through the slides that I think are the most important for you to save your time, and let's be somewhat efficient here on this YouTube channel. The first slide I want to show you is the investment thesis that they lay out. They say they are at the forefront of the HPC, AI, machine learning, and edge computing revolution. HPC stands for high performance computing. They have a refocused strategy and a new management team. They've realigned their strategy, focused on pursuing fast-growing opportunities within large global defense and commercial markets. The new leadership team has a track record of success driving growth and profitability within defense and commercial markets, and that's another thing I encourage you to do. I won't highlight it in today's video, but look at the management team that OSS now has. It's been completely, it's a completely new management team, completely new board of directors with a lot of strengths and a lot of tie-ins to very large companies that have grown very, very quickly. They're also going to be focusing on converting their $1 billion plus unfactored pipeline by developing integrated solutions and building multi-year incumbent positions and predictable sales. So yes, this company has a $1 billion pipeline and their market cap is just $79 million. Another common theme or comparison to yesterday's company that I presented is One Stop Systems is a money-making company. They are profitable. They're profitable, and we're in the infancy of AI at the edge. That gets me very, very excited. This company, I mean, it's hard for me to wrap my head around this valuation, even though it's already doubled up from when we started buying the company. It's still so extremely cheap, in my personal opinion, and maybe you'll think the same after doing your own research. But they have established technology positioned for secular HPC, AI, and machine learning trends. $17 billion global market for rugged edge compute for AI, machine learning, sensor fusion, and autonomy applications. Again, this marketplace is going to grow at 33% CAGR. They have 25 plus years of experience designing and manufacturing ruggedized enterprise class compute solutions for demanding applications on the edge. Another important point here is One Stop Systems is not just a company that is chasing what glitters and sparkles. What I mean by that is they have been doing this for years and years and years, which means they are very well positioned for this industry to take off in growth like it's projected to do, because they have experience doing this. They have the relationships they need to have a competitive advantage and a moat around their product. You can read into all of their different technologies, their hardware offerings, their software offerings. I'll let you do that on your own because it can get kind of complicated pretty quickly, but it's best in class. That's all you need to know. Now, they talk about their strong financial position and growth-focused outlook. They have a strong balance sheet. Again, this company is kind of priced like it's going bankrupt, and it's nowhere close to going bankrupt based on the balance sheet. They have zero debt. I shouldn't say zero debt, but next to zero debt on the balance sheet, and plenty of working capital, plenty of cash. And again, they're profitable. They actually added cash to their balance sheet from operations just last quarter. And that's only going to grow as time goes on, and they demonstrate their operating leverage. They have a multi-year, I don't know if I mentioned this, limited CapEx requirements to support strategic growth plan. They can support more than a double up of their current sales numbers under their current operating footprint. That's what I mean when I say operating leverage. That's going to be straight margin expansion and more profitability going to the bottom line for shareholders. They have a multi-year revenue growth supported by their OSS segment. I'll discuss that in a little bit. And they're expanding gross margin by pursuing higher margin market opportunities and leveraging fixed manufacturing costs within the company's OSS segment. So let's take a little bit of a pause here, mostly because I need to drink water. If you look at the screen here, you'll see that next year analysts are anticipating OSS will deliver revenues of $60 million, which would be 9.4% revenue growth. Not bad. Again, this company is in its infancy. This industry is in its infancy when you compare it to its projected growth. However, I think analysts are way off with their estimates here. And it's because One Stop Systems, another healthy indicator for the company, they have a positive book-to-bill ratio, meaning their order intake is higher than the revenues or sales they're putting out. Their book-to-bill ratio over the last 3 quarters was 1.25, meaning they're taking in 25% more in orders than they're sending out in orders, which means moving forward, this company will have at least 25% revenue growth annually. And the company has even hinted at this in their earnings calls, but for whatever reason, analysts aren't catching on to this. Now, only 3 analysts cover the stock. Again, this is a relatively unknown company. It's kind of that's the area of the stock market that I like and I really flourish in, is in things that are unpopular. I view popularity in the stock market as kind of a risk. And in opportunity, I think, is found in what's unpopular. Not everything that's unpopular is an opportunity, but that's where opportunity is found, in my personal opinion. Now, the reason the stock was trading down before August of last year was because this company went under a strategic pivot to integrate these defense opportunities. Again, they see that when it comes to the edge AI marketplace, it's really the Department of Defense and the government contracts that's where it's starting to bloom first, and it's just going to expand to commercial markets moving into the future. Now, they talk about this pivot here. They added proven defense industry leaders and reprofiled their board of directors. They created a new multi-year strategy. They rebuilt their sales pipeline to over $1 billion, and they reduced exposure to legacy, low-margin, non-core markets. This year in 2024, they focused on converting their pipeline to orders. Again, they produced a positive book-to-bill ratio of 1.25 through Q3 of last year, a very, very positive indicator for the company moving forward. And they established new customer-funded development revenue stream. And I'll talk about that in a little bit, but this is aimed at basically securing the incumbent position. Because when it comes to AI on the fly, AI at the edge, and basically making that remote data center a mobile ruggedized data center, they can have some specialized hardware, specialized software that they develop for their customers. And if their customers like it, they're more likely to be sticky customers than most other industries out there. In 2025, their growth, or Their plan is to return to growth and profitability, with 2024 orders expected to return one-stop systems to year-over-year sales growth in 2025. They're going to expand their gross margins further. They're going to be EBITDA positive. They're going to see improvements in the European markets as the European economy starts to turn around. And then in 2026, next year, this is when it starts to get exciting. Accelerated growth, continued organic growth, platform acceleration from customer-funded projects, service and support, EBITDA expansion through operating leverage, greater international sales, and mergers and acquisitions that are aligned with the company's growth strategy. And by the way, this is actually my mistake. I think I've gone this far in the video without saying this is not a pre-revenue company. They're going to do $55 million in revenue this year. So, the market cap, $75 million. It's treated like it's a pre-revenue company, but they already have established revenues. And I guess I said they're already profitable. So that kind of was redundant, I guess. If they have profits, obviously they have revenues. But if in case some of you out there didn't realize that, no, this company does have legitimate revenues and legitimate contracts. Here they talk about their pipeline and their unfactored pipeline growth, what they see going into 2028. In 2024, obviously, we've mentioned their pipeline has exceeded $1 billion. This is more than $1 billion in revenue opportunity for the company that the company has identified. And by 2028, they think this pipeline is going to grow to over $2 billion. So their pipeline alone is going to double over the course of 4 years, over the course of 3 or 4 years, which means their revenues should also probably double over the course of the next 3 or 4 years. Again, a very, very exciting indicator for the company's future. Now, just to talk about the customer-funded development revenue a little bit, because this is a very, very important piece of the company, and actually indicator for the company. They do this, as I mentioned, to establish an incumbent position and opportunity to expand within platform architecture. They do this to transition to multi-year contracts for production, support, and tech refresh at high margin with predictable backlog and revenue. So again, customer-funded development it's what it sounds like. The customers are funding the development of hardware and software solutions that OSS will provide for that customer. They take a little bit of a gross margin hit to secure that incumbent position with customer-funded development, but again, they think that customer-funded development will lead to production margin of 40% plus. So very, very strong margins there. And they've even used the language that almost always customer-funded development leads to production orders and this 10-year total life cycle annuity at product gross margin percentage. So this is hardware refreshes, software refreshes every 2 or 3 years, etc. Service life, they get paid for that over the course of 10 years. It's kind of the product life cycle. And they get paid over the course of 10 years for this. And they mention here how they have around a $450 million cumulative platform opportunities from 2023 to 2028. And these just stack on top of each other. If you want a good figure, the management team has mentioned that customer-funded development usually represents 10 to 20% of the total revenue opportunity once the customer-funded development gets into mass production for that customer. And then if you want to go through this investor slide deck for yourselves, they give you some different case studies, different program wins they've had, the benefits that their customers have seen, the United States Navy, a data center customer, etc. I highly encourage you to go through this investor slide deck for yourself. But the next most important slide that I want to cover is this one here, their capital allocation priorities. They want to maintain an asset-light business model. They have limited capital requirements needed to support their growth. They can more than double their sales within their current operating footprint. And their biggest use of capital historically has been to support working capital, which is no longer much of an issue. They want to sustain balance sheet strength, maintain their strong cash position, continue to pursue strategies aimed at improving those working capital efficiencies. They want to strategically invest to drive return on investment, product development initiatives for best-in-class ruggedized products at the edge, add proven sales and marketing capabilities to accelerate their growth opportunities. And then lastly, they want to pursue accretive acquisition opportunities where they add hardware and software capabilities, customers, geographies, or new technologies. And they want to ensure that these align with their current strategic plan. You can go through the company's recent press releases and see some positive news. Just this morning, they announced $6 million in combined platform contract renewals of contracts. Again, remember, sticky customers here for 2 existing United States Department of Defense programs. Another press release that they put out recently, they announced a follow-on order and design win from a leading defense contractor in Asia for an autonomous maritime application. Again, AI on the fly. OSS is really the only company that I've identified that is heavily focused on this, which gets me excited. And then the last press release I'll mention is they announced a design win with an award-winning AI infrastructure company. This is the data center customer that I was talking about. The initial order is valued at $2 million with shipments expected to begin in the first quarter of 2025. And voila, we're already in the first quarter of 2025. So the growth here looks really, really strong, even though it's really even yet to grow and blossom truly. But all signs point to a very, very strong business moving forward. And the fact that the company is already cash flow positive means the downside for the stock is also limited. Even if AI at the edge doesn't explode like I think it will, the risk is minimal based on what the company's current valuation is. And that's the asymmetric investment opportunity that I like to chase after. Now, just to close out this video like I usually do, this is my one-stop systems fair value spreadsheet. I started this video off by mentioning some of the risks. This is young, so it's very hard to predict the company 10 years out. You know, if I'm trying to predict Apple 10 years out or PayPal 10 years out, it's much easier than doing that with one-stop systems. Still, I do my best. There's a 100% guarantee that this will not be correct. I mean, I'm going to be wrong with my numbers somewhere, so keep that in the back of your mind. This is a spreadsheet that I make available to my members. Again, shout out to you guys for watching this video. If you're still here watching this, you know, usually my stock picking videos are actually they have my lowest watch time because people pop in, they see the ticker symbol, they go buy it, and then they leave the video, and they just don't care about the research due diligence. And yeah, obviously that's problematic. So shout out to you if you're still watching. And thank you so much for your support. If you want to go the extra step, you can check out my membership by hitting the join button next to the subscribe button if you're on a computer, or just hit the Patreon link in the pinned comment. Anyways, let's talk about this. Here's my numbers. I already told you that for next year, analysts only expect the company to grow at like 9%. I think that's way off. I think in 2026, the company will grow at 20% at least. My number here is actually probably low. Like I probably should anticipate 25% revenue growth in 2026 and probably should anticipate 20% revenue growth in 2025. But again, as we get numbers that come in and as the company issues new guidance, I'll have no problem coming back into this spreadsheet and bumping up my numbers if I have to do so. The important thing here, again, company I anticipate to be profitable this year. They're cash flow positive last quarter when it comes to our operations. And I think for the full year, they're going to deliver, in 2025, they're going to deliver 2 cents of positive earnings per share. Again, that could be low if my revenue numbers are wrong, but a very, very good sign. Next year, I have that, or in 2026, I have that growing to 23 cents earnings per share. Again, my numbers probably are low. You'll notice I try and be somewhat conservative with these numbers. But by 2035, based on a CAGR for the company of 25%, 25%-ish. I have the company reaching $500 million in sales by 2035 and delivering net income to shareholders of over $100 million for earnings per share of $5.38. And if my numbers are right at all, it means the company will be a $161 million company at a forward PE multiple of 30. Now, I don't have any dilution factored in here. Just because the company doesn't really dilute shareholders, and you know they might in the future for acquisitions and whatnot, but those acquisitions should be accretive to shareholders. So the dilution shouldn't take much value away. But as those acquisitions or mergers happen, yeah, I'll change my anticipated dilution. But bottom line, it really shouldn't impact the share price too much when it's all said and done, but I'll keep my eye on it. If you want my opinion right now, this company should be valued around $13 per share based on 2024's numbers. And again, the company's trading for less than $4. So I believe even now the company is tremendously undervalued. I'm happy that it's undervalued because I can keep buying the stock. I hope it stays undervalued for a long time. Because I want to keep buying. I think this is a company that's going to set me up great for my future. And it's one of those retirement portfolio companies as well that I really believe could be a massive winner over time. And it would be great not to have to pay taxes on those gains. So I'm going to be buying more shares in my Roth IRA and whatnot. But with that, I hope you guys enjoyed this video. Let me know what you think of this company down below. Obviously, it's more risky than the one I mentioned yesterday. But if AI goes the direction I think it's going to go, this company's going to be one of the first to benefit from it. They're already benefiting from it. When we look at their book-to-bill ratios, their revenue growth, anticipated revenue growth, their pipeline, their backlog, et cetera, all positive indicators for the company. Without further ado, hope you guys enjoyed this. Stay blessed, keep 10 toes graded, chin up. Peace out.